1.3205. Cable is in freefall, down 6 to 4 basis points today alone, and yet the retail crowd is still trying to catch this falling knife. That is the trap. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade today, with stops, targets, and risk-reward ratios on the screen. This is not a drill. The pound is entering a liquidity vacuum where stops get run and accounts get blown. Let's get you on the right side. Write this number down, 1.3334. That is the daily pivot, and it is the only level that matters today. If we get a 4-hour candle close above 1.3334, the entire bearish structure resets. Until then, the bias is unapologetically bearish. We are trending, not fading, not range-bound. The session bias is a strong sell on every time frame from the hourly all the way up to the weekly. The ADX is sitting at 24 and climbing. The CCI is crushed at -260. That is not an oversold bounce signal. That is a trend that chews up dip buyers and spits them out. The herd is long. Retail sentiment data shows over 60% of traders are trying to pick a bottom here. That is gasoline on the fire. Institutions are soaking up that liquidity, pushing price deeper into the danger zone. If you are long right now without a hedge, you are the liquidity. Let's walk the charts, because this is where the real story unfolds. Start on the weekly. The weekly candle is a massive, bearish engulfing pattern that has sliced through the 100-week moving average like it was not even there. We are now trading below every major weekly moving average for the first time in 6 months. The weekly trend is a strong sell, and that is not a signal to fade. It is a signal to follow until proven wrong. The monthly chart remains neutral, but it is teetering. A monthly close below 1.3000 would flip that neutral to strong sell, and that opens the door to 1.2500 later this year. That is the structural backdrop. Now drop to the daily. This is a graveyard of broken supports. Price is below the 200-day moving average at 1.3383, below the 50-day at 1.3433, below the 20-day at 1.3396. The 20-day has crossed below the 50-day, a textbook death cross that just confirmed. The moving average ribbon is in perfect bearish alignment. The MACD is deep in negative territory with no bullish divergence on the daily, just expanding histogram bars. The RSI is at 31, not yet oversold enough to trigger a meaningful snapback. The Williams %R is pinned at -99, indicating extreme oversold, but in a momentum-driven liquidation, oversold can stay oversold for days. This is not a buying opportunity yet. Now the 4-hour chart gives us the tactical battlefield. We have a series of lower highs and lower lows, the most recent swing high at 1.3330, just below that pivot. The critical support that held for multiple sessions was 1.3228, the S1 level. That is now gone. Price sliced through it this morning, and it has already been retested as resistance, and it held as a ceiling. That is classic technical confirmation. The next support is S2 at 1.3155, and below that, S3 at 1.3049. These are not arbitrary numbers. 1.3155 is a monthly support level that has not been touched since the rally began in March. It is a magnetic zone. The pivot at 1.3334 is reinforced by the confluence of the 4-hour 200-period moving average and a previous demand zone that now acts as a supply wall. If price ever gets back there, it will be a heavyweight fight. But right now, we are trending lower, and the path of least resistance is a test of 1.3155, and likely a break toward 1.3050. Here's what most traders miss. On the 4-hour chart, the last swing low was accompanied by a hidden negative divergence on the MACD histogram. The histogram is making lower highs while price is making lower lows. That signals trend continuation, not exhaustion. Most retail traders see a divergence and assume reversal. This is not bullish divergence. This is a stealth acceleration signal. The smart money sees this and adds to shorts. I want you to see it too. The hourly chart adds more urgency. We are printing a clean bear flag right now, with price consolidating around 1.3200 to 1.3220. The 5-period hourly moving average has crossed below the 10, and both are sloping down sharply. The hourly MACD is attempting a bull cross, but it is rolling over without ever crossing above the zero line, a classic bearish reload. The volume profile shows heavy selling at the 1.3228 breakdown, and very little buying interest stepping in. The market is waiting for the next catalyst, but the structure is already primed. Now let's connect the dots to the fundamental firestorm driving this. The pound is the dollar killer today, but it is the one getting killed. The Bank of England minutes from the June meeting dropped a bombshell. The MPC is deeply divided. Some members are worried about persistent services inflation, while others see a rapidly deteriorating growth outlook. The phrase "a more challenging task" was not an accident, it was a warning. The market now prices a much lower terminal rate for the Bank of England, while the Fed stays hawkish, patient, and data-dependent. The 2-year yield spread between the UK gilt and the US Treasury has exploded to fresh multi-month wides in favor of the dollar. That yield differential is the raw fuel of this cable sell-off. When you add risk-off flows from equities, the S&P 500 struggling at gamma levels, the VIX ticking higher, the pound, which acts as a high beta risk proxy, gets pounded. Cross-asset linkage is screaming, DXY is ripping, gold is confused but heavy, and the yen is getting intervention talk while sterling just gets dumped. This is a policy divergence trade of the purest form, and it has room to run. For the next 1 to 2 weeks, my directional lean is further downside to 1.3000, possibly 1.2900 if the data lines up. The invalidation event is a daily closeback above 1.3334, or a sudden hawkish surprise from a bow speaker that resets rate expectations. But as of right now, that is not priced in. The minutes have given the green light to shorts. Do you think cable breaks 1.3150 this week? Comment yes or no below. I'm tracking consensus across our community, and it often reveals where the squeeze lies. Most people skip this next section. That is exactly where the money is made. Keep watching. I am giving you 3 trade setups: the sniper, the active trader, and the aggressor. Every single one comes with exact entries, stops, targets, and the exact conditions that void the trade. No guessing. Let's go. Strategy 1, the sniper. This is the conservative approach for those who want high probability entries with defined risk. Your plan: wait for a pullback to the newly established resistance at 1.3228. That level was support for weeks, and now it is a ceiling. Place a sell limit at 1.3225. You only enter on a 1-hour candle closeback below 1.3220 after a spike up. That confirms rejection and trap. Your stop loss goes at 1.3280, above the intraday high and above the psychological 1.3250 handle. Why there? Because a move through that zone means the bears lost momentum and the pivot at 1.3334 becomes reachable. Take profit 1 at 1.3155. That is the S2 support, giving you a tight, achievable 1 to 2.2 risk reward. Take profit 2 at 1.3050, the S3 yearly support, stretching your reward to over 1 to 4. 5. This setup is void if the 4-hour chart prints a candle close above 1.3334. That would mean the structure has flipped and the trade rationale is dead. Sniper. Patience. Precisioned, the sniper, conservative, entry, 1.3225, 1H close below 1.3220 after spike, stop loss, 1.3280 take profit 1, 1.3155 take profit 2, 1.3050 risk, reward, 1:2.2R to 1:4.5R invalidation, void if 4H candle closes above 1.3334. Strategy 2. The active trader. This is for those who want to ride the momentum without waiting for a pullback that may never come. Set a sell stop order at 1.3180, just below the current micro-consolidation low. This catches the breakdown as it accelerates. Stop loss at 1.3215. above the flag resistance and the previous minor swing high. Why there? A break above that mini range invalidates the immediate momentum and suggests a deeper retrace. Take profit 1 at 1.3120, a level that aligns with the prior weekly low from February. Take profit 2 at 1.3050. Once target 1 is hit, move your stop to break even and let the runner ride. This setup uses the ADX expansion and the CCI extreme to capture the waterfall. The logic is simple. Strong trends don't give deep pullbacks, and you have to engage with a sell stop or you miss the move. This is a standard momentum play with a 1 to 3 risk-reward profile. Type your pound sterling to US dollar range for tomorrow in the comments right now. Let's see who's aligned. Are you seeing 1.3150, or are you pricing in a bounce? I read every single one. Let's build the collective bias to the active trader. Standard, entry, sell stop at 1.3180, stop loss, 1.3215, take profit 1, 1.3120, take profit 2, 1.3050 risk, in reward, 1:3.0 trailing stop, move SL to BE after TP1 hit strategy 3, the aggressor. This is a counter-trend scalp, high risk, and only for traders who can manage risk aggressively and accept a small loss without hesitation. Here is the setup. If we get a sharp spike down to the 1.3155 support zone and the 15-minute RSI flashes a clear bullish divergence, price making a lower low while RSI makes a higher low, you can take a tactical long entry at 1.3160. This is a bounce play against the tide. Stop loss at 1.3130, just below the S2 level and the psychological round number 1.3150. A breakdown below there triggers a fresh wave of sell stops and you do not want to be long through that. Take profit 1 at 1.3200, a quick scalp to the broken intraday support turned resistance. Take profit 2 at 1.3240, near the consolidation high. This is a 1 to 2 risk reward on the first target, but the win rate is lower. Only take this if the divergence is clean and the DXY shows a short-term top. Warning, the trend is ferociously bearish. If the 4-hour candle slams through 1.3140, this setup is void and you must not fight the flow. Aggressor trades demand iron discipline. No exceptions to the aggressor, high risk, entry, 1.3160, 15M RSI bullish divergence required, stop loss, 1.3130, take profit 1, 1.3200, take profit 2, 1.3240 risk, reward, 1:2.0R, TP1, warning. Trend is strong sell. Void if 4H breaks below 1.3140 with volume. Now, a quick risk management pulse, because no trade plan is complete without it. Never risk more than 1 to 2% of your account on any single trade. Do not hold positions through high-impact news events like UK CPI or US jobless claims. Stops are non-negotiable. They are your oxygen mask. This is how you survive to trade the next big move. The market will be here tomorrow. Make sure you are too. Let's bring it all together. The single most critical level for the next session is 1.3334. That pivot is the line in the sand. Below it, bears are in full control. Above it, this whole structure folds. But until then, the gravitational pull is toward 1.3155 and then 1.3050. Tomorrow, we have US initial jobless claims and a slate of Fed speakers. If claims come in hot and the dollar strengthens further, cable could accelerate into that 1.3050 zone within hours. That is your wildcard. If you want the full breakdown on Bitcoin and the S&P 500 divergence, where the liquidity tide is turning, that video is live right now. Tap the end screen. Smash like if this gave you a clear, executable plan. Subscribe, hit the bell, and I will see you in the next one, before the next explosive move hits.